Welcome to Good Grazing Makes Sense, brought to you by the Society for Range Management. I'm sitting here talking with Jordan Steele of Ranch Management Consultants. It is February 23rd today, and I can't be the only one who's worried that I've gotten all my tax prep done. And I do pretty good with my books, but it feels like there's always something I should be doing or something I'm missing. So, Jordan, before we dig into some, I don't want to say tax advice, but some tax basics. Can you tell us a little bit about yourself, who you are, where you live, what you do?
Sure. Yeah. Thanks for having me, Dave. Yep. Name's Jordan Steele. I'm a full time ranching for profit instructor. I live in Laramie, Wyoming, and I've been full time with Ranching for Profit or Ranch Management Consultants for 3.5 years now, I think. My wife and I actually lived in Colby, Kansas from 2015 to 2022. And that's where I learned. I worked in the Kansas Farm Management Association, and that's where I learned real life farm and ranch accounting, and that's where we did a lot of income tax returns. Primarily, all of our members down there, we did the income tax returns for, along with all of the farm income analysis and everything too. So we were doing record keeping, financial analysis, trend analysis, and income taxes. So that's where I, like you said, you really learn stuff after you get out of college.
Yeah, agreed. I wasted a lot of my college time and then had to do a lot of catching up
Yeah,
as a
right.
grown up, as an alleged grown up. So our taxes, I know I'm not the only one that has this like gut feeling like, oh, I got to get all the stuff into the tax guy. And what does the accountant need from us as producers? How can we best serve our tax accountant to give us our best return, or for a little sleep good at night feeling? What can we do?
Yep. So I think a couple things come to mind there, Dave. First one is just have a good set of books and keep them updated. You know, whether you're using the two most common platforms would be QuickBooks or Ambrook. I work with lots of clients that use both of those. They work real well. Have a good set of books and keep them updated. You know, we get bank statements monthly, so at least do them monthly. You know, enter everything monthly, get them reconciled in. Both of those platforms will do online feeds, so you can have them pull the transactions in. Now you have to go categorize them and name them and all that stuff too, but you can do that. I mean, weekly, daily if you want, but at a minimum, I like to do them monthly because then you can just reconcile to the bank statements and then get everything filed away, and then that will help you and your tax person, your accountant, CPA. I probably going to use the terms interchangeably here. That will help them know what's coming for the records and for the year. And then with that too, depending on if you're doing it by bank statement, don't forget to run the January and the February one just to make sure you get all those late December checks to clear the bank to make sure they get in the records. If you have
Yeah,
if you have
there's
some
that
that
in
carry
between
over.
time that can fall. Yeah, I know I
Yep,
purchased that fuel on January 31st, but it didn't show up until late, or vice versa.
correct.
You
Yep,
can't see it,
yep.
but I have a regular calendar invite for the first of the month that says, "Do Integrated Grazing Management's books," and in
Books.
capitals, "Do not let anything get in the way of this. This is what you do today."
Right, yeah. Don't
And
change this time.
I almost always like, oh, snooze till tomorrow, snooze till tomorrow. But when you talk about keeping up your books, what does that include? So let's say we're talking to somebody who's not using software, Ambrook, or the name is escaping me, QuickBooks. What does that mean to keep your books up?
To me, it's just making sure we could call it monitor cash flow. So, I mean, some people could use Excel or even a file folder system. You know, if you don't want to use a computer, get all those receipts and have a file for income and have a file for expenses. And probably, expenses, you're going to have more categories of those for maybe some for, fuel and repairs and the vet bill and the feed bill and stuff like that. So you could have an individual folder for receipts for those. Just making sure those are all organized and somewhere you can get them. So
Yeah, I know those folders or buckets. We often call them They're chart of accounts, right?
yep,
That's
yep,
just want to bring the nomenclature down so we can all be on the same page.
yep. And that's what, if I were to say chart of accounts, I'd be thinking of the computer software or a file folder or some sort of three ring binder for paper receipts, is probably what I would explain it
Yeah.
as.
It's all
Yep.
the different buckets that you would categorize your expenses and incomes.
Yep.
I
Yep.
got income from the sale of calves. That's one bucket in the
Yep.
chart of account.
Yep, and if you could, if you look at your individual tax return, if you're just a sole proprietor, you could look at your Schedule F, and that's going to give you income buckets and expense buckets for each set of accounts, and that would be a baseline starting point, anyways.
So I get asked this question a lot, and I honestly don't have an answer. You alluded to if you're a sole proprietor. Can you walk us through the differences between sole proprietor, LLC, partnership? What are the common ones that are out there, and what should people be thinking about
Sure.
when they
So,
choose?
so lots comes to mind when you think of your entity structure, and that's what. So, sole proprietor is the most basic entity structure, and that's sole proprietor is just Jordan Steele doing business with my social security number. You can attach a name to it, but it's still linked to your social security number. It gets filed on your individual income tax return, which is the Form 1040. And then another type is a partnership, which is, Dave and Jordan could go in 50-50 on this partnership on the ranch, and we own everything 50-50. And that return is going to file a Form 1065 and then issue us K1s. And so those will get reported on our individual income taxes. Then there's one more level that could be an S corporation, and that is also a pass-through entity like the partnership, but a little more. There's a few different things with partnerships versus S corps. Both of them are pass-through entities, but they have different ways for owner compensation and a little bit better liability on the other one. And so that's a basic on the S corp. And then there's also a C corporation, which is probably going to be one of your more of the like large corporations are generally going to be C's, because C corporations pay their own tax. Remember, the other two, they pass through the taxable income to me as an individual. The C corporation actually pays its own tax. Then I'm coming back to a couple of them. Then there's the LLC, the limited liability company. And the LLC is actually kind of a wild card in all of them, because the LLC can choose to be taxed as a partnership, can choose to be taxed as a partnership, an S corp, a C corporation, or if it's just a single member LLC, then it will be reported on your individual income tax return. So the LLC generally, most of the time, they're partnerships. But if someone says they're an LLC, you actually got to ask the secondary question of what's your tax filing on that too. So that one seems to be always the confusing one.
Yeah. Yep. Oh, you got another one? Is there another one?
Yeah, there's one more type of entity, and those would be some sort of trust or estate. So with trust, there's revocable trust and irrevocable trust. Generally, the revocable trust just operates under your social security number until you pass away, and then it gets an EIN, and then it helps administer your estate. And then the revocable trust means you actually give away the property to that irrevocable trust, and it starts as its own entity now. So
Okay.
all of them that I just listed have different tax benefits and disadvantages, have different estate planning advantages and disadvantages, and different liability protection advantages and disadvantages. So the entity structure can be a pretty hot topic at the coffee shop, and so be careful when you're selecting your entities.
I get asked that question as if I could answer it like oh, you should just be this.
Right.
We got to sit down for a while to talk about this.
Yep.
You said something and you started defining it a little bit. I just want to dig deeper into what pass through means. I think you got to it, but can we talk a little bit deeper about that?
Yeah, so the pass-through entity, the partnerships and S corporations, what they do is you have your own set of record keeping and books and stuff for that, and then it calculates its taxable income and it files a tax return, but the taxable income gets reported to you on a K1, and so you actually add that to your taxable income. So most commonly with an S corporation, what people will do is if they farm a ranch out of the S corporation, then they work for the S corporation and they draw a W-2 as wages from the S corporation. And then any profits on top of that will also flow through to them, and then they pay their respective taxes. So if Jordan and Dave were in an S corporation 50-50, we'd both draw out wages. And then if there was also a $50,000 profit taxable income out of that, then we would split that, and 25,000 be reported on your income tax return and 25,000 be reported on my income tax return.
In that situation where there's profit, couldn't the entity hang on to that profit as reinvestment so it doesn't hit your personal tax liability?
Yep, absolutely. So there's several ways to do tax planning around that. Like you said, when you do tax planning there, then you'd want a tax plan at the corporation level and at the individual level. Same thing, we want to manage that cash flow. Usually what I like to do is in those cases is like I said, if the corporation is issuing us a taxable income, then we probably want to take some sort of tax distribution, right? So, we distribute some cash out to the individual to help pay the taxes. But like you said, we want to make sure we protect the cash in the corporation to make sure we can function for the rest of the business year on that cash too. So got to manage both of those there.
Yeah. Okay, so we talked about two things here: understanding your entity and then doing your books. Would you say that do you run into people in the right entity for the business they're running? Is that a common problem, or is it?
This one's hard to answer. And here's the ranching for profit, it depends answer.
Does it depend on your context?
Absolutely, 100%. And then it also, I always tell people we make the best decision with the information we have at hand. And knowing that if this entity is alive, 75 years from now, we're going to have different tax rates, different Congress, different rules, and all that stuff. So, I always feel like we do a really good job of setting our clients up for the right entity. But we have some old, I can't remember the exact year, but in the mid 80s, I want to say, there was a pretty big tax law change. And so we have some old S corporations in ranch that are absolute tax nightmares. And what you can get is the land is trapped in the S corporation. And at that time, that was the best entity to set it up. But now things have changed and it's worse for us. And so and there's nothing you can't manage by with just doing a little planning and having some grace and being willing to change there. But it's pretty easy to say, right now, most tax preparers would say the best entity for land would be a limited liability company, and the best entity for operating would be an S corporation. But that's going to change over time. So
yeah. So would you say then that just understanding what entity you're in and making good decisions and planning around that is probably the first step, rather than just going out and changing your entity structure to fit whatever's going on in your head today?
Exactly. And before you set up an entity, talk to your accountant, talk to your lawyer, talk to your insurance liability. Don't just go to LegalZoom.com or whatever and click a few buttons and now I've got an entity, because that's in my opinion, that's not the most proper way to go about that.
It's almost too easy to set up, right? I feel like it doesn't make you do your homework before you do.
Yep, you can just go online, file it with the Secretary of State, whatever state you're in, and off you go.
Yeah. So we're understanding our entity. We're making our decisions and our planning based on best practices within that entity. We're keeping monthly books. We're keeping track of what's coming in, what's going out. What's the next thing that gets us a better night's sleep before April 15th?
So right at this time, you're going to be collecting all of your 1099s. All of those are either going to be hard mailed or some sort of electronic delivery. And so getting those to your accountant as soon as you can, and knowing which ones you expect. Like, farmers and ranchers are going to receive patronage and government payments and crop insurance or the PRF, the pasture, range, and forage stuff comes in as crop insurance 1099. Trying to think of other ones. If you do any machine hire or custom work for other people, they'll most likely send you a 1099. So getting all that stuff wrapped up, and bank interest 1099s. So if you're doing, depending on what accounting you and your accountant are doing, if you're going to do a balance sheet, a lot of those bank 1098s, the interest paid statements, will give you the balance and the interest paid. So that'll help you get an accurate balance sheet. those are going to be the most common ones. And then like off farm stuff, you're going to have your W-2s, interest. If you're doing anything with HSAs or stuff like that, they'll give forms. And then your IRAs and Social Security and stuff. So there's a whole pile of paperwork that you can get to your accountant on time. I feel like there's always kind of a hurry up and wait game. And it's right about now where everyone feels like we have everything, but then you go to look through the list and you're like, oh, I'm missing my Edward Jones statement or something like that, And so then there's a halt, and making sure the tax software is always updated, because some of the business forms aren't quite ready yet and that's on our side as the tax preparer, that there's a hurry up and wait game there too, and then it's a mad dash for the last month.
Yeah, I'm right in that situation right now. Last week I was feeling, I got them all wrapped up, and in the mail just the other day, something I didn't even think about. It was a 1098. Like, oh yeah, I didn't even think about that. It's
you'll need this. Yep.
Right. I think it was for 18 cents or something like that. But anyway, I didn't even think about
interest income on my big savings account. That's usually that one.
Yeah. Okay, so a lot of these things you're describing are things that would be in that other income bucket.
Most of those would be other, yeah.
Yeah, right. I mean, you might parse out a few of those, but it sounds like a other income type thing to make sure you've got all those checked off.
Yep, that's right.
Yeah. Okay, so we're planning based on the entity we have. We've done our books religiously, at least monthly. Now we've gone through all of our other income and the tins and all those things that need to go to the tax guy. What's next?
And then if you got the books in and you got your tax papers in, and then there's just going to be a period of giving them some grace. If you show up to, I always told people in Colby, I said, don't be afraid to bring a dozen donuts or something to the office if you stop by, because that'll be when your name comes across the phone or the email, it's a lot easier to be like, oh yeah, I'll get that done if you bring some donuts or depending on the office, maybe a 6-pack of beer would help. And so that have some grace there, because it's easy to pick on the guy that brings their stuff by on April 14th and expects it to be done, because it's not going to be. You're going to get an extension. So
that leads me into exactly what I wanted to talk about, is just common courtesy. What are the common courtesy rules? So bring donuts, possibly a 6-pack. Don't show up on April 14th. When, from your standpoint, when should these numbers be in? Like, what's your best? What do the best customers do? When do they send their stuff in?
Anytime you get them all. I think once you get them all, then you can, package them up and mail them or hand deliver them, depending on if you're, where your tax preparer is, because we don't have to live in the same town anymore to do this stuff. Scan them in. That's the nice thing about a lot of electronic programs, is you can just scan them in and upload them as you get them. And then as the tax preparer, you'd be like, you go grab this file and be like, oh, I think everything's in here. So you can go get them there.
So another common, just another common courtesy thing here. I want to pick on. Do you send everything as one bundle, or do you send what you got and then keep sending documents to them?
Me personally, I would rather have the whole bundle. That way, when I pick up your file, I can knock it out and get it done. If it's pushing up against a deadline and there's one page you're waiting on that, we can do the tax return without it. It's nice to have the verification. Then you could send that stuff in. But I find that when I sit down and work on, Voth Ranch, I want to just finish it, because it takes me too much time to get my head wrapped around it the next time when I get back into it. And then you're like, oh yeah, this is all I needed. And then you make that change and print it off. So me personally, I would rather get them all at once. But then we also have to realize that both of us are probably going to forget something. So if you send them in piece by piece, then when we go through and review them, then we might find that other one we're looking for.
Yeah. A bundle with a few additions when they come in is one thing. But I was thinking, I would hate to be on the receiving end of one piece at a time. Exactly. And then having to bundle it myself. And I don't want to build a 5-wire fence with 4 wires and then have to come back, because I'll never go back and put it on.
It just won't have that bottom wire.
Yeah, it's just not going to, despite no matter how many donuts you bring me. Okay, so we bundled everything up. We're allowing some grace. What about? It sounds like we're in the time now. After the grace, things are done. We receive them. How do we review them, or is there a step before reviewing things?
No, so generally what's going to happen is you're going to send your papers in, and then we're gonna get to work on it. We're gonna double check the bookkeeping, enter everything into the software. We're most likely going to compare to the estimate. If we did some tax planning last fall, we're going to compare to that, make sure it was close, make sure we stayed on plan. We're going to check to last year's tax return, make sure we didn't forget anything, make sure there's consistency or known differences there. And then we'll send it out to you. And when you receive it, then I think it's a good thing to look through it and at least make sure you know what the forms are and know what the numbers are. Make sure nothing's outstanding, glaring at you. I mean, we hire professionals to do other stuff for us, but we at least need to be knowledgeable about what they're doing. So like if you're selling a bunch of cows, those are going to show up on the form 4797. So I want you to be able to look through that return and make sure you can at least see the big ticket items. And then once you review it and everything is the same, then there'll be some sort of, like I said, either electronic email or actually sign the paper and send it back. There'll be some sort of permission, the form 8879 that says, yes, I have reviewed this, go ahead and e-file it. And then that's the final permission for me to click the button to e-file it.
It can be pretty daunting when it comes back to me and you're just scrolling through page after page of this PDF. And
yes.
Yeah.
Yep.
So look at the highlights at least.
At least know the important pages there. And I trim down a lot of those extra pages. There's a lot of extra pages in tax returns, and I think a lot of them are extra. And so I kind of try to trim down my returns to just those main ones. So it can be pretty daunting, but I also don't want, we're in this together. I use the email electronic signature quite often now. I'm getting more and more used to the technology part of this, but there's sometimes I get the electronic signature back within like 15 seconds of me sending it. And I'm like, okay, I know you didn't look at that. Let's do this a little bit different. So that's kind of what I'm talking about reviewing it there.
Yeah. You said that you'll double check the books. I'm sure you're not going through it with a fine tooth comb. Same thing. Are you just looking for big chunky things that might be out of whack?
Scanning through it. And so what I'm looking for, like matching up, patronage is an easy one to pick on because the co-ops a lot of times will do some sort of deferred patronage and some sort of cash patronage. So
can you define patronage?
Patronage, the short definition is a lot of the cooperatives will do a profit share. And you as members get a part of a profit share. Part of it comes in a cash payment, and then part of it gets deferred, meaning they'll pay you later.
Is that the patronage part, the later part?
That's the patronage part, yeah.
Okay.
And but like when I check the books, if you're using software, if I check the books, most commonly it's probably just the cash portion entered into the books because that's all that hit your checking account. But there's actually that deferred portion too that needs to go on the tax return. So I'll reconcile to that. The interest 1099s, make sure we get all the interest and principal splits out there. Those are going to be the ones I check. So.
Okay, I'm going through everything. We've gotten our return back. We've reviewed it. Next step after that? Click the box.
Yep, check the box, get it e-filed, send your payments in if you owe, or do direct deposit if you get a refund.
I forgot about the writing the check part and sending it in.
Yeah. That one always has to take place.
Yeah, that hurts.
That's a good point, though, too, Dave. We brought up extensions earlier. If you extend, extension is only extension to file, not pay. So on April 15th, if you extend your return, you should send an estimated payment in based on what you think you're going to owe to. That's the way it reads. If you don't pay it in, then you're going to have to pay interest on the months that's late. So
that is such a good point. Last year was the first year I used the extension, and I was shocked that I still owed money right away.
Yep. And so there's kind of, as self-employed individuals, we're required to make quarterly estimate payments, right? If you don't, you have to pay them interest. We're recording this, so I have to be careful about how I say it, right? But if your bank's interest rate is more expensive than the IRS interest rate, maybe you should just pay them interest, right? So depending on where you're borrowing or where your cash flow is coming from, you can work that interest rate to your favor.
And we're talking tax management here, not tax evasion. My 12-year-old daughter knows that. Right. The difference very well. And she's always telling me tax management, right? Exactly.
Yep, correct.
Okay, we've got a pretty good view. I'm already working on a little better night's sleep with just that rundown of the process. There's a
Good.
couple terms that I just don't have a good handle on. So let's talk depreciation and let's talk basis.
Okay.
What you want to give a quick example of depreciation? We can talk at a very base level of what depreciation is.
Sure. Depreciation is going to be on your capital purchases. And so a capital purchase meaning an asset that you can use for more than 1 year. So if you go out and buy a pickup, uh, depending on if it's new or used, you can depreciate it over. Well, pickup might be a bad example because I think they're 5. I need to touch up on that. You know, farm machinery is going to be 5 or 7 years, right? So we go out and we buy a tractor, and we spend $100,000 on a tractor. We don't deduct that whole 100,000 in the first year. We can place it on depreciation, so we take that $100,000 expense over a mixed percentages over those 7 years. That's depreciation. So we're going to take that capital purchase and deduct it on the tax return over multiple years.
And that depreciation is describing the value of that piece of equipment as it's getting older, its value is getting less.
Yeah, and that's the way it's supposed to work with machinery, and I'm going to call them metal assets. It works closer because if you buy a tractor, 99% of the time it's going to go down in value as you use it, right? And so it's kind of mimicking that. Cows can be a whole different story. So that's what when we talk about depreciation of the market value asset is a lot different than depreciation of the tax asset.
Right? Two totally different things.
Yes.
Do you have any more we should touch on depreciation?
Yes, we should talk about accelerated depreciation. So there's two types of accelerated depreciation. There's bonus and there's Section 179. Both can be highly advantageous and both can be abused a little bit. So Section 179 is for your shorter term properties. Basically all of your machinery and equipment can be used for Section 179. And with it, you can kind of pick how much depreciation you want to take this year, and then you put the remaining amount over those multiple years. Bonus is more of an all or nothing. And so sometimes it can actually push you too low, but sometimes it's really advantageous too. Both of them have limits and both of them have different class lives that you can take advantage of. But the biggest thing I want to talk about with depreciation, accelerated depreciation, is if you're borrowing money with those, we have to be careful with accelerated depreciation. Because back to the tractor, if you buy the tractor on borrowed money and you take all of your accelerated depreciation this year, well, your last year's payments, you're probably going to have a cash payment to the bank without a tax deduction. And so it's pretty easy to get in a bind there with accelerated depreciation on financed money. If you're buying assets out of profits and you're paying cash for them, write them off. Not even a question. But if you're using financed money, we have to balance that long-term effect of accelerated depreciation.
Yeah, that's exactly where I wanted to go with this. The difference between depreciation on borrowed money where you're making monthly or annual payments versus depreciation on something you paid cash for. And I think you covered that pretty well.
Cool.
That's
Good. Good.
I know that was a big question I had last year, and I'm still not sure I made the right decision.
Yeah. And it's all on paradigms. I mean, we can always pick on paradigms, but most of us don't love paying taxes, and so that's part of it. So we can use them to our advantage. But I've also seen people avoid taxes into bankruptcy uh, farther down the road. So I don't want that to happen either.
Yeah. What does Dave Pratt call them? Monuments to
Tax avoidance, I
taxes?
think. Yep. Yep.
Buying
Yep.
large things that don't make you any money. Paying $100,000 to avoid paying $10,000.
That's right. That's right. Because and that's the math never lies, and we no matter, even if we're in the highest tax bracket, we still get to keep most of a dollar. I'll leave it there, but there is a lot to that. Yeah.
Ready to move on to basis? This is one that
Sure.
I'm still really fuzzy on basis. This
Sure.
kind of eludes me. What
Well,
is it? Why does it matter?
so yeah, that's a big question. Basis is it in a way it's everything. So the tractor, if we were to talk about the tractor, its original cost basis would be $100,000. If you take $20,000 depreciation on it the first year, then at the end of the first year, it has $80,000 tax basis. And then if you take, let's just make it easy. If you do 5-year straight line, you take 20,000 each year, right? So then your depreciation is $20,000, a $20,000 deduction each year. And then your tax basis would go from 100 to 80 to 60 to 40 to 20 to 0. So
Okay.
that's what tax basis is on the machinery.
How about when it comes to livestock?
Livestock. So let's talk about two different kinds of livestock. So, and I'm only going to be talking about breeding stock. So purchased breeding stock like cows or bulls, because, purchased yearlings for resale would be different, right? Those are an inventory animal. But if you go out and buy cows, you depreciate those just like machinery. And so your tax basis will go down as you take depreciation deductions each year, the same. And then the important thing, with machinery, not so much, but you're eventually going to resell that stuff, right? And so if you, let's say,
Allegedly, yeah.
Allegedly, right? Yeah.
Yeah.
If you spend $2,000 on a cow, you get to depreciate her over time. But then the biggest deal with cows is, if you sell them later, your tax basis is going to determine what part of that is ordinary income and what part of that goes for capital gains. And so there's actually 3 different tax rates, but there's the ordinary tax rate and then the capital gains tax rate. And so your basis, depending on where you've taken depreciation, is going to trigger that capital gains rate. Now, if you're in a business where you're raising heifer calves and you're keeping all of your own cows, and so a lot of your cash revenues are from raised cow sales, they technically have 0 basis because we deduct the cost of raising them, right? You deduct the feed into them, the vet, the fuel, all of that stuff you deduct into it. So they have a basis of 0. So all of your raised cows over 2 years old, so basically they have to have a calf, and then they go away from a production unit to a capital asset after they have a calf. That's kind of how I read the 2 years. And then after that, they switch to long-term capital gains, which can be a really, really big deal for ranches selling a lot of cows.
So how important then is it to keep track of our cow ages?
Very important.
Good.
Very important because for like right now we're in a very high market, right? And so this is kind of Wally Olson stuff, but we got to know our cow bell curve to know where our most valuable cows are at, right? And as we capture cash out of them, then that's economics, right? We're after profit first. And then on the tax side, it helps better too. Excuse me. Because those cows, as long as they're 2 years old, we're going to capture the most value out of them, plus pay the lowest rate on them tax wise. That's win-win.
Yeah.
So that
this is
really
very
works
well
for some ranches.
Yeah. So yeah, they don't each have to have their own birth certificate, but having a good idea of at least percentage exactly. That are 8 and 9 and up, and those that are 5, 3 to 5.
Yep.
Just having some sort of idea of that.
Yep. I usually encourage people to keep track of, at Ranching for Profit, we call them H1s, which are your replacement heifers, H2, which are your bred heifers, your first calf heifers. And then let's at least keep track of youngs, middles, and olds, right? 3s, 4s, 3s, 4s, 5s, 5, 6, 5, 6, 7, 8 plus, 10 plus, whatever breaks are there for your ranch. Because I always, it's easy to put ages on them, but your young cow in Nevada is a lot different than my young cow in Wyoming is a lot different than a young cow in eastern Nebraska or something like that.
Yeah. So, yeah. There's heifers out here that really don't have their first calf till 3. You turn out to calve at 3 or later.
Yes. Yep.
Way different. Right. Yeah. All right. I feel pretty good about basis. Is there anything else we need to know about basis for the
only other one would be land basis.
Okay.
That would be a big deal. So if you as you buy something, you establish basis in it for what you paid for it, right? When you inherit something, you get a step up in basis, and now we have to put the caveat on there depending on the entity that the land was held in. You have to be careful with that. But if you inherit land, let's just assume everyone just owns it in their individual names. If you inherit land, you get a step up in basis to that, which is to a fair market value of your area, right? So if grandpa paid $50 an acre for it 50 years ago and it's now worth $1,000 an acre, there's a $950 capital gain in there if he were to sell it. When grandpa passes, if he leaves it to, let's say he skips a generation and gives it to the grandkids, well, they get a step up in basis to that $1,000 per acre upon his death. And so the heirs can then sell it tax free because of that step up in basis. So
I see.
that step up in basis is a big one, and that's why it's usually getting challenged in court for that reason. But that's right now the estate rules are real high on that estate tax exemption. But that's where a lot of people are looking at it. So because it doesn't take long before there's several million wrapped up in a ranch.
Yeah, just back to the livestock basis. One thing I learned here today, and correct me if I'm wrong, whether the cattle are purchased or ranch raised, either direction should work out the same. We just have to keep track of which one it is. If it's ranch raised, we're deducting everything that went into raising her. If she's purchased, we have that basis just in a different form. It's meant to be the same, right?
It is, yeah. Yep.
Yeah, and if we don't keep track of it ourselves, it doesn't get kept track of.
Yes. Yep. I would agree with that. It just depends on like you said, the purchase is going to be pretty close. It's just dependent if we write a check for it or if we write a check for inputs.
Mm-hmm.
And then, but then upon the sale of that animal, it'll reclassify that different as depreciation recapture income or capital gains income.
That sums it up pretty well. I feel like that's a rule that's meant to be there to keep these things equal. It's just how we get to that end result.
Yep.
All right.
And that's how, with the taxes, like I always tell people, if you have a really good natural resource set for yearlings and you can buy and sell yearlings and pay the highest taxes on them, stick with that. Don't go into cows for lower taxes when you make less money, right? We're pursuing after tax wealth. So
perfect.
If we can make $500,000 and pay $150,000 in taxes, we're still $350 ahead. So if we make $300 on the cows and pay no taxes, we're still not doing as good, right? So
say it again. We're after. Say you're.
Let's pursue after tax wealth increases.
I love that. That's the perfect place to end this. And I'm looking at the time, and as usual, I've just gotten into a fun conversation, and 40 minutes have gone by. I could talk to you all day, Jordan, but people driving along in their truck probably have to get out and go check something at this point. So perfect. I'm going to end it there. You have anything you want to plug?
Nope. Come see us at our Ranching for Profit school. Look us up, or if you have any questions, on taxes, you can email me or get a hold of me somehow too. Just Jordan at ranchingforprofit.com. If there's a chat or anything, we can throw it in there too.
Yeah, we'll definitely link RMC and Ranching for Profit and all that stuff into this. Jordan, thanks. This has been, I feel a little bit more relieved. I think I can get a better night's sleep.
That's good. I don't want to leave anyone more stressed after this.
That's the idea. Thanks, Jordan.
Thanks, Dave. I appreciate it.